Welcome to Capital Link's Trending News podcast series. In this podcast series, we have the opportunity to discuss with company management on recent news and announcements they have made. We have with us today Dr. Loukas Barmparis, President of Safe Bulkers, listed on the New York Stock Exchange under the ticker SB. Safe Bulkers is one of the major international providers of marine dry bulk transportation services, transporting with their fleet of about 40 dry bulk vessels, cargoes such as coal, grain, and iron ore worldwide. I'm Nicholas Bornodis, President of Capital Link, Investor Relations Advisor to Safe Bulkers, and as per our disclaimer, our podcasts are for informational and educational purposes. They do not constitute investment advice or advice of any kind, and obviously Capital Link bears no responsibility for them. Today, we are going to discuss the strategy and implications of the latest acquisition of a Capesize vessel by Safe Bulkers. So, Loukas, thank you for being with us. Safe Bulkers just announced the acquisition of a 2014-built Japanese dry bulk Capesize vessel, 181,000 deadweight tons carrying capacity. This expands your fleet to 40 vessels in the water, and it is your sixth Capesize vessel. The majority of your fleet is in asset classes like Panamax, Post-Panamax, and Kamsarmax. So can you share with us what drives your increasing expansion into the Capesize segment?
Thank you, Nicholas, and thank you all, and good morning. We decided to go with this new acquisition of a Capesize class vessel, which is actually the sixth vessel, as you said. We bought another one last November, which was the fifth. So right now we have six vessels. I don't believe that this represents a substantial change of our focus, because the company is focused always the medium-sized vessels, Kamsarmax to Post-Panamax. However, we believe that the Cape market is also able to give us some money, and we had this, and we developed this opportunistic acquisition, we believe, by buying this vessel, which is very short, very prompt delivery, beginning of February.
So, as you mentioned, the Maria, the name of the new vessel, is a sister vessel to the Capesize Stelios that you bought, if I remember well, during the fourth quarter of 2021. The purchase price for Maria, as we disclosed, is $33.8 million. And you mentioned that you took advantage of the Capesize market seasonal weakness to conclude this transaction. Can you elaborate a bit on this?
Yes, it's very easy to understand. I mean, this Cape, in October, its value was about, investment value was about 41.8, if I recall well. So by buying this vessel at 33.8, and we had a substantial competition in this price, so there was interest for buying, and we managed to conclude. It is something that is quite opportunistic. We managed to buy it at a very reasonable price, a Capesize vessel, a Japanese Capesize vessel, noting also that Capesizes are quite expensive. If you make a new build right now, it's quite expensive. So I think we prefer to acquire a second-hand vessel at this price rather than making a new build order.
Well, that takes me to the next question, that you have been very active in fleet renewal and expansion. As you depicted in your latest company presentation, you have sold 7 older vessels, you acquired 4 younger ones, and you just added the Capesize vessel we talked about. And you also have 9 new builds on order to be delivered anywhere from Q2 2022 to the first quarter of 2024. It is worth pointing out that the majority of your fleet, 80% of it, is Japanese built. So what drives your fleet renewal and expansion strategy?
Look, we started with new builds, and we managed to order 9 vessels ahead of the competition, with delivery dates from I would say April this year until beginning of 2024. If we put additional orders, the new orders will be delivered after the second half of 2024. So we think that basically we have explored the ordering of new builds. And then our next point was how to, having these 9 new build vessels with the latest regulations that will be will be implemented globally after 2025 in terms of greenhouse gas emissions. The question is, how can we continue the renewal of the fleet? So this is what we did. We sold older vessels. And we have managed to we managed to sell 4 vessels at quite high prices. And we acquired younger vessels, always opportunistically, like this acquisition. So basically, we managed to renew the age of the fleet, and at the same time have a big portion of our fleet, about 25%, in the latest technology that is not available right now. What we need to recall is that from 1st of January 2023, the new regulations of IMO will dictate certain emission restrictions in terms of CO2, which means basically reduction or more efficient vessels. And we prefer to have Japanese vessels because in general, they are more efficient compared to other nationalities. They have advantages in terms of operating expenses. So we have seen also reduced operating expense in Japanese vessels compared to Chinese. And by having a majority of Japanese fleet, I think we can easily, more easy to comply with the new regulations rather with the Chinese ships or the Korean ships.
Loukas, you mentioned that you have bought the ships opportunistically, but the opportunistic element, as I understand, it relates to the timing. You have a well-defined strategy when it comes to fleet renewal and expansion. And as I heard you saying, you placed the new building orders in advance of competition. Now you're buying a Capesize, taking advantage of the seasonal softness of the market. So it's the timing element that allows you to maximize the best value for your acquisitions. Am I right?
Yes. Timing is very important because if you order, for example, now a new build, you will get it in the second half of 2024, and it will be maybe 5 to 10 million more expensive compared to the price that we bought. And the second point is that we didn't go to buy a Cape in October when the price was so high. So we just monitor always the market, always the asset play. And when we find the right opportunity, we just try to pursue it. We have substantial liquidity, we have the financial resources, we have low leverage. All this help the company to be opportunistic wherever we want.
So you opened the door to the next question. You mentioned that Safe Bulkers competes on the basis of a renewed and environmentally advanced fleet. And you discussed with us the impact of the upcoming regulations, the advantage of the Japanese-built fleet. So can you expand on this, and can you share with us measures, proactive measures that you have taken as Safe Bulkers to enhance the environmental efficiency and footprint of your fleet?
Look, we do what it is well defined right now in the market. So we test low friction paints. We test energy efficiency equipment like ducts and fins that can be applied during the dry docking. These are measures that are taken in the existing fleet, of course. And apart of that, I think the most important issue is that the company is focused on the renewal. So younger ships generally are more efficient. I want to tell you that about 70, according to certain studies, about between 70 and 80% of the global fleet does not belong to a phase 1, phase 0, phase 2, phase 3, whatever. which means that they lag from the regulations that will be implemented next year, and they to put EEXI and implement speed reductions, which means slow steaming. This could be another parameter in the future that will play or will affect the availability of the fleet. And together with the lack of availability of orders, I think will support the chartering market.
So, Loukas, if you would be kind to share with us your insight on the strategy you have, the financial strategy you have followed so far for Safe Bulkers, and what do you plan to do with your robust cash flow in terms of alternative asset allocation options?
Yes, look, we have developed a strategy. We did a substantial fleet renewal and ordering of new ships, which, of course, as you know, have already paid the advances for the acquisition of such ships. We have been targeting a leverage ratio of about 30%. I think that will be close to that ratio towards the end of the year. So that in terms of the leverage, we are spot on. And of course, the company at this point has a substantial surplus. The surplus can be used always to opportunistically acquire second-hand vessels if the market is, suits us. I mean, if there is an opportunistic acquisition like the one that we have seen, it doesn't mean that we are focused on that. The second point is that you can always use all the other things that someone could think. For example, you can always buy back preferreds. And of course, we are keen also to, at some point, to reinvest the dividend. And as I have already mentioned several times, in order to reinvest the dividend, the company is in a very good shape. And we want to see the perspectives during the next period if the market recovers, because right now we have a seasonal weakness and we want to see this recovery. We believe in the market.
Well, obviously, the key point here is you have delevered. So you have achieved a very good leverage ratio. You have robust cash flow, and now you can examine a number of alternatives in terms of how to allocate your surplus cash flow. Share with us now, concluding question, your outlook for the dry bulk sector, please.
Yes, look, I mean, the outlook is, we are very confident that the market will recover. We have a very low order book. We have the slow steaming, which will come from the 1st of January 2023. I will say also the risk right now is China, because there are certain headwinds there. But I believe that the Chinese government has shown that they always very reactive, and they are trying to take the appropriate stimulus measures for their economy. So overall, I think this is a good for the chartering. Any correction is good for the chartering market, because the China will be able to stimulate in the following months, and will have a very a chartering market which I think will be similar to past year chartering market. So I think that it will be a good year.
Besides China, do you also see more market strength as the result of infrastructure spending across the world, including the US?
Look, I think that all major consumers are introducing stimulus packages for infrastructure, etc. But we need to see also, we need to know that China is approximately 50% of the overall market, which it's India, it's China, it's Europe, it's the United States. I reasonably believe that the strength of the market will be there. The market will recover, and we'll have a similar year to the past year, which was a very good year for the dry bulk market.
Loukas, thank you for being with us. Thank you for your insight. And that concludes our podcast. And for more information on the company, please visit www.safebulkers.com. Dr. Barmparis, thank you for being with us.
Thank you very much. Thanks.